good morning, everyone. Thank you so much for having me today and for listening to me ramble on for the next hour or so with you. I hope everybody takes a little bit of value out of the session today. Also, feel free to message in the chat box where you're dialing in from. I always like to know where in the UK or even abroad people might be. I am in London today. And so just to give you a little bit of an introduction to myself, I am Amy. I am head of our partner channel here at Capitalise. So I have been here for about 6.5 years. I've done almost every single job you can imagine in Capitalise, from sitting on our funding desk, managing a portfolio of accountants, but now I oversee our entire accounting channel. Feel free to connect with me on LinkedIn after. Always happy to have a chat, or if you've got any additional questions. So look, today what we're going to be doing is we are going to be breaking down the spring budget and how you can help your clients thrive. So we're going to go through the 4 E's of the new industrial strategy, the themes from the government that are coming out, UK's inflation rate, how that's predicted to drop to 2.9% by the end of this year, the shift to localization and decision-making for grants and funds, and how you can ensure your clients are thriving. So without further ado, I'm going to hop into our first slide. Right. So it was very clear that this budget was a growth budget from the government. There wasn't a huge amount of new stuff in here, but what we really feel is that the budget has started to roll this government into a different place, and the way that they look at smaller businesses. These things have been emerging over the last few budgets, but really what we're seeing is that they are giving businesses less opportunity to get fiscal benefits, i.e. tax cuts, and they are giving focus to the following areas. 1, innovation. 2, working to net zero. And 3, leveling up. And I think that almost everything, I think that almost everything that they have done indicates that this is where their focus is. So some of the positive things that came out of the budget, of course, inflation expected to fall to 2.9% by the end of this year. I will touch back on this later in a different slide and discuss what that might mean. That GDP is expected to only contract by 0.2% this year, as opposed to what was forecasted that could have been minus 1.4% at the back end of last year. And also what's positive is that the fiscal rule around government borrowing, they actually look on track to achieve a falling percent of debt to GDP over 5 years, which is great because that will help us achieve their aggressive growth targets. So if we look at the tax system and the tax benefits associated with this government, they are increasingly oriented around innovation. Better tax benefits for companies who are spending more than 40% of their income on R&D, and rolling the super deduction off into 100% for capital expensing. Now, look, I am not an accountant. You are the accountants. I'm sure you guys could teach me a lot of stuff about tax. So that's not what I'm going to go into today. I'm going to talk a little bit more about what this means for your clients. So some of the businesses that are going to do very, very well out of this government and out of this budget, the ones who work in AI, carbon capture, life sciences, and renewable energy suppliers. But, if we break down these 4 E's and what they were setting out to do, they transpire into things like subsidized childcare, local investment, back to work apprenticeships for over 50s, adjusted income limits for pension tax, and disability benefits reform. And overall, this was a budget that was absolutely focusing on getting people back into work. So if we go on to the next slide here, one of the things that the government announced is that there's going to be 12 new investment zones with access to grants and tax relief worth up to 80 million pounds over 5 years to help drive growth. So in reality, if we break this down, the BBB came out with a study a few weeks ago, and they were basically saying that innovative companies grow 23% faster over a 6-year period. And in that 6-year period, they employ 21% more people. These are the businesses that will use more capital via grants, private equity, debt funding, whatever that might be. But ultimately, if these businesses are growing, employing more people, they're going to be paying more tax and contributing more into the economy, which is quite important. And so that means that there's more to take home for the government. And part of their agenda is to build new Canary Wharfs across the country to execute on their leveling up strategy. So these areas are going to need to develop proposals around things like universities or research institutes. And again, there is more focus on education and innovation here. And what's going to be really, really important about these investment zones is that they're going to be heavily localized. So they are going to be disbanding the LEPs, and this is going to be going into your local authorities where there's going to be specific grants for driving growth in your own local areas. Now, what I would highly, highly recommend for you as accountants is to stay on top of what is happening in your local areas and building relationships with your authorities and councils to understand what is up and coming. This will enable you to give better advice to your clients. But the other thing is that the local authorities sometimes will reach out to accounting firms to get their opinions on things that they should be doing to drive the local economy. So you can also be a very imperative part of driving the growth you want to see in your own areas. Now, look, there's going to be more and more stuff coming out on this. We don't know what it looks like yet, but it will be happening. So as I said, just keep on top of it. And I think one thing that's really, really exciting for you as accountants, it means when there is more investment going across all of the UK, that means there's going to be higher growth businesses. There's going to be a chance for you guys to give better advice to a different array of clients and ultimately help to grow your own practice. So I think what we should see over the next few years is something really, really exciting in terms of the leveling up if it goes to plan. So look, let's talk about what's happened over the last 30 years. We all benefited from cheap money, cheap goods, and cheap energy. And that was a mega trend, which absolutely created, I think, the wrong impression that people got about how you can get money and how you can grow that. But ultimately, we no longer have cheap energy from Russia. We don't have cheap goods from China anymore. And we don't have cheap energy from the banks because the central banks are raising rates in order to curb inflation. So when thinking about the advice that we give to our clients, we really, really need to be thinking about the fact that this is the new normal, that it's not going to go back to what it was like pre-COVID, that ultimately this is a world we live in and we've got to plan our strategies around that. So let's talk about the fact that we are avoiding a technical recession. So what is a technical recession? I don't want to teach anybody to suck eggs, but this is 2 quarters back to back of economic contraction. So as I touched on before, it is really exciting that the OBR has come out and said, look, last year we thought we were going to contract by 1.4%. Now we're only going to contract by 0.2%. But really, this means that we got to get the inflation under control. So they have said that inflation is going to go down to 2.9% by the end of the year. But I think it will be a challenge to get there. And the reason why it will be a challenge to get there is because, you've got inflation is simply an equation, and that is the average cost of goods this year over a 12-month period versus last year over a 12-month period. And when you got bumps in the global economy, it can create more challenges, right? So with Silicon Valley Bank, with Credit Suisse, there can be more global uncertainty, or things like today where it came out that the government borrowed more in February this year than they have since 1993, which was a bit shocking. And that is to pay for the subsidies on energy that they're helping all of the households across the UK with right now. The one benefit of that is the fact that because inflation is down, the cost of interest is down slightly, but it will definitely be an interesting route to get there. I think getting inflation to drop right now is the easy part. Once we get to that 6%, it's going to be challenging to get under that. We've seen this in the United States with the Fed. They keep saying, look, we've got inflation under control, and then waffling a little bit. But I think the major thing to look at in this graph right now is the fact that even if we get to 2.9%, we're still going to be above that 2% that the Bank of England would like, which means it could be a long road for us no matter what. So, I think these are just things to keep in mind when speaking to clients about inflation and will we actually get down to that 2.9%. Sometimes a very, very long period of stagflation can be worse for the economy than just going through a short, sharp recession and bouncing back and being even stronger. So we'll see what happens there. So look, let's talk about the base rates from the bank right now. Hunt came out and said debt servicing costs are down, inflation's peaked, mortgages are down. It's great. And we are actually starting to see a little bit of that in the borrowing for businesses. So there's lots of lenders who are coming out and giving 5%, 5-10-year commercial mortgages, where we actually hadn't really seen a lot of that last year. And it's not that they didn't even want to give the rates, it's that they couldn't really figure out what the long-term economic landscape was going to look like. Now, that being said, we are now seeing the demand for borrowing, especially on the SME side, going up and massively. What we don't know what it's going to look like is the supply side. So I touched on SVB and Credit Suisse. Credit Suisse are going to be no longer looking to acquire assets, which could affect some liquidity. We don't know what's going to happen, but there might be a slight retrench in the amount of funding that is available. Or what we saw last year was a lot of lenders definitely looking closer at the businesses that they are looking to give money to, and a heavier dependence on credit scores and affordability. And I'll touch on that in a little bit. But I think the one thing that we need to be really, really mindful of rates with right now is the fact that there's a few challenging meetings coming up this week. So we've got the Fed and we've got the Bank of England. And what they're going to have to manage and what they're going to be battling is the global bank challenges with versus inflation. So we don't know what's going to come out. We thought maybe a few weeks ago they'd be hiking rates again, but they might not want to do that because they want to cool everything off. So just watch the space, see what happens. And then I'm sure as Capitalise, we will be in touch to let you know what our thoughts are on after that. So I guess this all boils down into a question. Can business owners be confident after this budget? There's corporation tax increases from 19 to 25% and the marginal rates higher. Employing staff is becoming more expensive. R&D tax credits can be harder to get now. And the question is, are sales actually growing? So what I wanted to do was actually just take a minute and talk to you about the Zero report that I actually found. So they came out with this, and let's talk about businesses reporting on sales. So businesses are reporting that sales are up all in all 5.1% year on year. Now, as you can see that this cash graph is going down over time. And we expect that because COVID was a crazy rocky road. Almost every single graph I look at seems to have a dip or a peak and then something on the other side of it. But what is more worrying here is actually these sales growths do not take into account inflation. So actually, if you put 9% inflation in there, sales are actually shrinking by 3.7%. They're not growing. And this is something that we need to be really, really conscientious of, because one thing we hear all the time with accountants or their clients are saying, look, our sales are growing, but I had 100 grand of cash in the bank last year, and now that's all gone and I don't understand why. And it's because actually, are they looking at their margins? Are they looking at the cost of running their business in terms of the costs are going up? Now, if we talk about wages and why this was really, really important for the government to focus on getting people back to work, right? We've got a record high increase in wages, right? Up 3.4% on average, up 4.8% year on year, which is excellent for those people coming into the workforce. However, we still have a 1.1 million job, 1.1 million pounds of job, not pounds. We still have 1.1 million job vacancies across the UK. What does this mean for business owners? This means that people coming back into the workforce to fill those jobs still have the ability to negotiate on salaries. That means it doesn't get any cheaper for your SME clients or even yourselves as accountants to hire cheaper labor, which ultimately we need to fix. So we need to start filling those job vacancies until we can normalize the salaries that people are getting paid. And then the other thing that's happening is that time to be paid has gone down to 30.5 days. And, using digital tools like Xero is great. It can help you get on top of these things. But what is worrying here is obviously broadly, you've got a downward trend over time outside of when the pandemic hit, because there was a lot of uncertainty. But since September of last year, that time to be paid is creeping back up. And so it's getting worse, which means that businesses are not managing their cash flow as well. And also it could be that they're not getting paid on time, which has a knockdown effect. Insolvencies are up. So there's lots of things contributing into this. But, you know, a lot of this information comes from UK SMEs. And so this is absolutely speaking to what the government's agenda is in terms of like, how can we level this out and get our economy back to growing? So how does this boil down from a capitalized world and what we're seeing in terms of SMEs in general? So if we look at the lending landscape right now, there's a volatile market. You know, we touched on Credit Suisse, Silicon Valley Bank, 1 in 3 businesses, and this is all businesses, not just small ones, has less than 6 months cash. Insolvencies are up 32%. That number feels like it just keeps constantly creeping up, and lending products are changing all the time. You've got lenders coming into the market, you've got lenders leaving the market, you've got them changing their appetite. You know, one of the biggest lenders in the UK just pulled out of construction lending and sold their whole book. So there's a lot going on right there. In terms of funding, as I said before, we're seeing the demand for funding go up. Last month, we did the most funding at Capitalise that we've done since CBILS. So it's definitely coming back, and we're definitely seeing more people get into this space. But we've also seen a 45% increase in urgency. So people aren't coming in saying, I need funding in a month or in 2 weeks. They're saying, I need it right now. And it's because small business owners leave themselves 7 days, 1 hour to get the funding they need in the bank. And typically they apply to one lender, which is their bank. And, you know, obviously incumbent banks will give the best rates if your clients are able to get that. But the issue is they often can't underwrite a loan in that time frame. So how can we get them into a wider part of the lending market? But because rates are higher, the affordability required is going up. And then if we look at what's happening in the credit world, and this is credit scoring, credit scores are down 9% on average across all industries. So the credit hurdle for a lot of lenders is going up. It used to sit around 35, 40, and really we're seeing that around 45, 50 out of 100. They want to see better, more stable businesses. And only 29% of businesses even know their credit score. So we're seeing small businesses go out to apply for lending, to get that capital in that they need, and ultimately they're being knocked back because of their credit score. I've got this box highlighted in green here, 6 times more likely, because Experian are one of the investors in Capitalise, and they gave us some interesting data that less than 1% of businesses actually track the credit scores of their major debtors, suppliers, whoever that is, but they are 6 times more likely to have the best credit ratings. And that is because they're managing their risk early on. And I'll touch back to that a little bit later, but in terms of bad debts, you know, I touched on that fact that it's on average getting paid in 30 days, but 87% of invoices are paid late. 61% of businesses are unaware of where their cash spend is going, and 56.4 million hours every single year are lost on chasing bad debts. If you think about 56.4 million hours going back into doing the things that small business owners love, like working with their clients, developing new products, that could also help us with some growth. So we'll talk a little bit later on some tips that you can do to help them get in a better place with this. So I thought I would just pull this out because there are some key sectors to watch, and it seems like construction is always at the forefront of this. They tend to be the highest for insolvencies, but right now, construction is the sector with the highest amount of companies who are in the lowest credit score bracket, who are at the highest risk. Then you've also got your haulage, you've got your hospitality clients, and you know, I think IT, information and communication. But I think what's really, really important to just notice here is that if you've got clients in your portfolio that sit in any of these industries, it's really important to have conversations with them now about credit scores or whatever that might be, because if these local enterprise, these local grants, etc., tend to come through and this leveling up is successful. These are people who are going to want to bid for this work and tender for it. But we need to get through this year, which we know is going to be challenging with the 0.2% contraction at least. And so I think giving them better advice so that they can grow in future now will really, really help. So let's talk about the business cash flow cycle. Now, you could break this down in any way that you'd like to. I mean, the way that I like to do it is let's talk about a business who is tendering for new work. So say you got a construction client, right? And they are going to tender for new work. So they win this new contract and they're super, super excited about it. But they don't go and check the credit score of their new debtor. Right. And when they don't check that new credit score of that new debtor, they haven't figured out that this debtor actually pays on average 60 days late. Right. And so then they go to Taylor Wimpey or whoever it is, they get their supplies to do this job, but they're not forecasting where all of their cash is going, and they're paying their workers on a weekly basis. And all of a sudden, this debtor doesn't pay them on time, and they're freaking out and they're thinking, oh my God, I've got to pay payroll right now. They go to get funding, and all of a sudden, they've got no affordability because they spent the cash in their bank. And they find out they got a low credit score because they're in a high risk sector. And even though they're a really strong company, they've been downgraded because of the industry that they trade in. And then they can't get the cash. And then all of a sudden they're in a very, very tough situation. And we see this happen all too much. And there are steps that small businesses can take to help protect themselves. But I think they need a little bit of education around what they can do to manage their risk earlier on. So look, as accountants, how can you help your clients? You can clean their data and you can move them onto cloud or move them onto monthly management accounts, right? What this helps is you can use tools that are available to you to spot where there are issues earlier on. You can have more regular conversations with their clients. You can figure out what's going on in their business today, as opposed to 6 months ago when they come in for their biannual meeting. You can help them with credit control, clean their debtor back up into a strong process. You can deliver a business plan for them. You can work with them on forecasts, understand exactly where their cash is going. And if there is a borrowing need, get it earlier on. Get the money in the bank earlier on. And then the other thing is, where we're going to focus today is talk about credit risk. So help them understand their client's credit risk and how to improve theirs, and then working capital. So how to get them to understand their internal and external working capital. So let me just take this back one step and talk a little bit about credit scores. Now, I'm not sure if anybody on this call does this regularly with clients, gives them their credit scores and their reports, or helps them track the credit scores of their clients. But credit scores are absolutely essential for small businesses to access the capital they need. And the thing is, you've got the lending zone, which I said starts at about 45 now. That's a Delphi score of about a C, B, or an A, going up from there. About 95% of the loans that we get approved at Capitalise, the client has a credit score of C or above. So if it's below, not saying it's not doable, but it does make it a heck of a lot more challenging. And then you've got the supplier credit zone, which starts slightly lower. And the reason why the supplier credit zone will start around 20 is because it is short-term debt. So normally you might be on 30-day supplier credit, right? So if you can build up a good track record of paying it on time, you can then go and get more supplier credit, where a lot of lenders are looking to underwrite business loans for, say, 5, 6 years even. And so they have to be really comfortable with the fact that that business is going to repay their capital and that they are going to be here long term. Now, if you look at it, right, year one, you got about 750,000 businesses. Year two, you got about 500,000. Year three, you're at about 300,000, because businesses fail a lot in the first few years. And until you get to that 5-10 year mark, there is a lot more risk, which is why credit scores are slightly lower. So One thing that we can offer at Capitalise is something called a credit review service, and this is through our partnership with Experian. And look, this is not a sales pitch about credit review service. This is just talking to you about how credit scores are made. So they are made based upon having limited amounts of information on small businesses, right? Because most people file abbreviated accounts, which means they can compare all small business accounts to one another and come up with an idea of the stability of what they think your client represents. Now, the issue that you have with that is that maybe somebody put in a big director's loan under a liability, or took a huge amount of profit out of the business, etc. So if we could actually take full accounts, debtor books, and all that kind of stuff into Experian and show them the exact situation of what's going on in business, or show the management for accounts for the year, which have like cracking performance or whatever that might be, we can actually help to get that credit score boosted. It's got a 97% success. It's got a 97% success rate on average. So if you're looking at that, that is one way to get free working capital into a business. So if we can take a business from having a credit score of D up to a B, we can ultimately help them get cheaper debt finance. But we can also help them go and say, look, my credit limit's gone from £500 up to 15,000, 20,000 pounds. Can I get more supplier credit? Which can help them really get their cash flow cycle back in line. I think in this day and age, stuff like that is really, really important, because if they've got lumpy cash flow cycles or they're seasonal, maybe they don't want to be paying back debt all year round. But if we just look at this long-term back on the graph, most businesses in this black line is actually the average credit scores of businesses. Most businesses don't even sit on the line where they can get borrowing at any given time. So if you're talking to your clients about growth and the message that the government is pushing, then this might be something you want to talk to them about in terms of their future plans and how you can improve it. So let's look at the impact of credit scores on funding, right? This used to be more like 4 versus 15% for an A-rated credit client versus a C-rated credit client. But, we're in a different world now, and 7% is a great rate. We see lots of rates coming through at 8%. It's not unlikely to see a higher risk client to be getting an 18% average interest rate. Now, it still stands true that historically £1 board puts £3 back into the economy. If debt is used in the right way, it can help businesses to hire that staff they need to develop those new products, to take market share, especially when insolvencies are up, because there's a lot of opportunity out there. So they need to be thinking about the cost of debt as something that's going to help them grow their business if it's invested in the right way. But ultimately, the difference between an 8% loan and an 18% loan can be almost £80,000 in interest over 5 years. So if you're having conversations with your clients who are thinking about borrowing, my recommendation will be talking to them about their credit score first, and then talking to them about what options they have in borrowing, and making a plan with them about that. So it could be that you are talking about, look, if you want to borrow, why don't we improve your credit score, try and get you some better supplier terms, and then we can look at borrowing in 5-6 months, because many lenders will not just look at the credit score today, they will look at 6 to 12 months credit scores on average. So I think the thing is that a lot of the time we see this sparked by a need right now, but the point of advice is long before somebody is actually going to look and execute on those borrowing plans. So this is something that I thought, that I thought I would just show you. So if you look at the bottom of this graph, this is average credit scores across all companies in the UK. So, you've got about 10% who sit in very low risk, about another 7% who are in that B-rated bracket. You've got about 30% who sit in the C, and then 50% of businesses sit in that D or below. So half of businesses right now, if we were to look at them on face value, couldn't get borrowing or would be subject to the highest rates. Now, whenever we tend to do this exercise with accountants, we tend to find that the credit quality in their portfolio is higher, right? Businesses who are working with accountants, who are coming up with business plans, who are forecasting, who are having productive conversations and getting the advice they need, tend to be more stable, right? And so if you're looking at this, we've got over 20% of all accountants' clients sitting in that A and B, but you still have about 30% who sit in that C category. And these are the businesses who probably can get borrowing, but are subject to the highest rates. And then still 40% across all accountants' portfolios that are sitting in that D or below category. So although you guys are making strides to help businesses get in a better position, there is a lot of stuff that we can be doing to try and help get your clients into that A and B. So if we just look at this here, why is this important for all of your clients? I've touched on this already, but if you've got people who are sitting in D to F within your client portfolio, you really want to help them improve their credit score to access funding. But the other thing is, likely their suppliers aren't going to be able to get insurance on them. And they're going to struggle to tender for new work, especially if they're in that construction type industry, right? Because people will look at this more closely. So I guess the conversation to have with your clients there is very much so around, hey, look, we've noticed that you've got a low credit score. Do you want to look at improving it? Is this affecting you? Or have you recently lost out on any new contracts that you're tendering for and you don't know why? Now, what's interesting is it tends to be that bigger businesses will check credit scores of smaller businesses, but not a lot of smaller businesses do that. And so that's why when we talk about in your B2C range, this is what I call your advisory zone. So these are probably clients that you are working with already that you might have a good relationship with, but they're, as I touched on before, they're going to be the ones who are subject to the highest rates, those 18%. They're the ones who are going to pay that £80,000 in interest, which actually could probably pay a couple of salaries, but also they're probably not tracking, they're not, doing the right things in terms of checking credit scores of clients, tracking and monitoring the credit scores of their biggest debtors and suppliers, and ultimately probably more reactive when it comes to raising finance. And they're in that 7 days, 1 hour on Google, high interest rates. And for your A and B clients, I think the stuff that we can help with at Capitalise is helping them get into a more tech-led solution. So when Experian invested in us, it's about 18 months ago now, just over, the challenge that they were trying to solve for was the fact that small businesses don't interact with their credit score enough. And obviously they're not as agile as we are, being a smaller company. And so they wanted us to rebuild their Experian credit profile, but also help them produce an updated version of the credit scores tracking and monitoring tool that they already had that's existing in their current way. And what ours does is that actually gives live dynamic notifications on any changes to any client that anyone in your portfolio is tracking. And why that's important is it means that you don't have to go log in a month later and find out that your biggest supplier that you've got $100,000 outstanding with that's turning into a bad debt has gone down to a G, which is basically being struck off the record. You can figure that out in real time, or if there's warning signs, so that you can manage those credit limits and those debtor terms earlier on. And so it might just be getting them onto something that can help them work a little bit more efficiently. So let us break this down into some sectors. So obviously I touched on construction before, but why do they need to have a good credit score? Well, they're reliant on their own credit score for credit terms, and their credit score will fluctuate based upon what is happening in their industry. Why they need to track and monitor other companies, highest risk sector, and it almost is always the highest risk sector for late payments. bad debts, and you hear about things all of the time. Just, it just takes something, one invoice, and all of a sudden companies are going under. And so that may lead to worries in the stability of the supply chain that they're working with. And in terms of what they borrow, asset finance, term loans, invoice finance, and definitely credit review service. I think the biggest thing is that there's lots of incredible construction companies out there, but they may be downgraded because of the industry that they trade in. And what we want to do is be able to show the real picture that this is a good, stable business, and give them the funding and the supplier terms that they deserve, and help them have an equal chance of success. So again, retail, hospitality, care homes are reliant on their own credit score for credit terms for borrowing. Credit scores downgraded due to their SIC code. And then they may be worried about the stability of their supply chain. What we see a lot of in this area is property funding, merchant cash advance, credit review service as well. Manufacturing and engineering, again, same story, but they tend to borrow a lot because they'll use invoice finance, asset finance, term loans, property finance when they're buying their warehouses, you name it, they've got it. But the reason why they would need to track and monitor credit scores of other companies, right? They're B2B and they've got risk of late payments. And the thing is that they may be working on different jobs all the time. And they also might be worried about the stability of their supply chain, especially if they're doing manufacturing for smaller companies. Is that company going to be around? Are they going to pay them, etc.? College, transportation, right? Lots of lending, again, lots and lots of asset finance in there. And they tend to be the bread and butter of invoice finance as well. Because, client drove from point A to point B, and we agreed a certain amount of money for miles. And so those invoices are very, very hard to refute. So a lot of them will tend to use invoice finance. And the invoice finance companies love them. So it really does boil down to what kind of sectors. These are just a few examples, but this stuff is relevant for pretty much anybody across the board. So look, I think I saw a question come through about how much is the credit review service. So the credit review service is, if they're on one of the Capitalise credit plans, it's £375. That is, as I know, of the cheapest in the market. So we actually had a client, and they came to us last year where we were outsourcing this, and it was costing them about £2,000 to be able to do this. But with our partnership with Experian, what we want to do is help build healthier balance sheets. And so we basically have cut the price to a point where it's super, super achievable for any small business. And, it's even firms that we're working with in the top 100 are saying, look, we're just going to do this for our top, 5-10% of clients and offer it just as like a value add because it can bring so much. So using CRS as a case study, right? We had a client who was looking for some funding. Ultimately, we're getting knocked back. So we did the credit review service. So they went from an E, a score of 37, to a C, a score of 74. Now, is that the best credit score in the world? No. But what did that enable us to do? Well, we got them a £40,000 offer where they were being knocked back and weren't getting offers before. And then their credit limit increased from £500 to £11,000. Now, across 10 suppliers, that's £100,000 of free working capital that they can go and use and negotiate better terms, right? And the thing is actually, if you've got clients who are borrowing on that D, E, F, whatever, if they can get it even, and they're paying the higher interest, make sure it's short term, because what you can do is do that credit review service, track and monitor the credit score for 6 months, 9 months, 12 months, and then go and run that for a longer, shorter interest, lower interest rate loan, right? So there are steps you can take to work with your clients. So although they might pay the interest now because they absolutely need it to get that cash in the bank, we can help them longer term, get them down from that £80,000 in interest to that lower rate. So, right, what I wanted to do is walk you through today how you can actually use the Capitalise platform for free. You can trial up to 10 clients for free on the accountant view to get some clients' credit scores and some insights on what is driving that credit score. And ultimately, what our platform will enable you to do is monitor your clients, segment your portfolio with filters, identify clients who need help, give you insights, alerts, and changes on your own client portfolio, view financial and credit risk data, and ultimately you can onboard clients long-term. But I find it just comes to life a little bit more when you can actually see how this comes to fruition. So what I'm going to do is I'm going to stop sharing my screen. And I'm going to just put a link in here. So if anybody hasn't signed up for Capitalise already, you can do it in under, sorry, I have managed to turn myself off. I'm going to put this into the Q&A box. Oh, can I actually do that? Because the chat box is disabled.
In the background, if you want, Amy.
If I put it into hosts and panelists there, is there any way that you can do that? We promise no technical issues, but here we go. We've done it.
Okay, let's give this a go.
Okay.
Right, okay, that should
Can everyone see that now? I'm hoping so, because I can't actually see anybody on here. Always the challenges with these things. But just take 2 minutes. It's literally like a Facebook sign up. All you need to do is put in your name, your email, your phone number, and make sure that you put down that you are an accountant, because then that will set up the right style of platform for you. And while you are doing that, what I'm going to do on my side is I'm going to jump into a demo version of our accountant platform that we already have set up. And I'm going to walk you through what this information means and how it's what it's bringing up for you and how easy it is. Okay, so just give me 1 minute here. Okay. I'll just give you everybody just one do that. All right. Okay, I'm going to pop back in. Hopefully everybody has had a second to do that if you want to do that on the call with me right now. But what I'm going to do is I'm just going to take a couple examples of clients. Here we go. Share screen. Let's go. Share a window. Perfect. So I hope that everybody can see what I'm doing right now on my screen. So okay, super. Okay, so when you sign up, every single accountant will get the same view on here, and you'll come into your dashboard. This really gives you just an overview of what's happening elsewhere in your platform. You've got your cases if you're helping clients raise finance, but ultimately what we're going to jump into here is Monitor. And so, as I was saying, Monitor is our in-house technology that we built. And really, I think this is the only thing that's out there on the market that's designed to help accountants manage credit risk across their portfolio, but also be able to get deeper insight into their clients. So anybody who's just signed up for that Flexi link that I sent into here, you'll be able to upload 10 of your own clients. As I said, the data becomes really real when you see it populate within your own portfolio. So on the risk profile, what you get is just based upon a company number. You've got the company name, their sector, their credit score, any changes that have happened, recommended credit limits, and how their suppliers are recommending that they pay them. I'm not recommending, reporting. Right? And so you can get a bird's eye view of what is happening across the credit in your client's portfolio. And if you want to, you actually can drill down into deeper insights. So who's got their credit score increasing, whose credit scores have decreased. So it can help you manage the risk within your own portfolio. Now, just looking at this, what is super easy is all you have to do in the top corner here is add a client here. And what this will do is you just pick a company name. Okay. And there we go. And then that will just actually add it into your monitor dashboard. Okay, perfect. So right here, you've got a client who's popped up. And what this will do is produce a capital report for them, right? So you can see their credit score. And luckily, this is a great client who's got a good score, a good healthy credit limit. And you can see how many times they have been searched in the last 12 months and 3 months. So really, if the credit score is low, and there's searches happening, this is going to indicate to you that there is something going on in that business, aka they are looking for funding, they are trying to negotiate better supplier terms, they're tendering for new work, and this should really be the basis of the conversation that you're having with your client, right? What's happening? Why are you getting searched? And then let's look at what's driving that credit score. So as you can see here, this is exclusive credit data that we've produced for you to surface for you with our partnership with Experience. So you can't get this elsewhere, but you can see what's driving that score and the things that they should be doing. So if we're looking at this, in this case, this client is looking like they've got really good asset to liabilities ratio, which is indicating a strong balance sheet. And then they've got a few things that are neutrally impacting, and neutrally, just to give you some clarity on this, means that it cannot positively impact it, but it doesn't negatively impact it. So for example, a CCJ, right? Yay, there's no CCJ. That's not positively impacting your score because the assumption is there isn't one there, but it can negatively impact your score. So as you can see here, nobody reports on this client payment performance, but if there was anything, you would be able to pick it up. So again, that's always just with a company number. So we've got a few in here as well. So as you can see, if you've got this client, Ribble Valley Building, we got, okay, so their credit score is a C. Their credit limit is 23 grand. So their credit score has actually gone up. Their credit risk has gone up, credit limit's gone up, right? But it's still not in that amazing zone. And obviously there's been 4 inquiries on them in the last 3 months. So this would be the perfect time to have a conversation with that client. What's going on, and ultimately what is sparking these inquiries on your credit profile. And in this case, what's going on with this client is that it looks like they're carrying some heavy liabilities, that they've got an unfavorable gearing ratio, and also that they filed their accounts late. And the thing is that what is interesting, and I never knew this until I worked in credit scoring, was that what Experian are looking for in each business is patterns and stability. And so if you've got a business who files 9 months after their year end every single month, then absolutely, they can tell that that's when that business is going to file it. So all of a sudden, if they're doing it 2 weeks after their year end, it's going to say that something is not consistent there, which is quite interesting. And then if we're looking at this business's payment performance, as we go along, we can see everything's great here, but something happened October, November, December. All of a sudden they started paying somebody late. Maybe they were having some cash flow challenges. But if you see this, or if you see this going red, this is a great time to spark a conversation with a client and figure out what's going on in their business. So again, if you wanted to enrich this a little bit further, you could connect their cloud and it will give you deeper insights into clients that have bad debts accumulating from 0, or if their rolling cash balances have dropped, etc. And this can really help you just get that at that next level of insight. Now, the one thing I always caveat with cloud is make sure the cloud's up to date, or the client's at least okay at doing their bookkeeping, because if they only update it quarterly for their VAT return, whatever that might be, a lot of the insights you'll produce won't do you a lot of favors. So then you got one step further. So if we look at this, that is your accountant view. You can get that on any client, but then you can also onboard your clients who need a little bit more help in this space onto their own Experian credit profile. And you can actually jump in once you've onboarded your clients to see what they see. And where this becomes really powerful is where I'm bringing a lot of this stuff to life. Sorry, it looks like I may have gone into the wrong one. Sorry, 1 second. Just stop sharing my screen for just a second and go back here. Sorry about that. I don't know what happened there. Okay. Right. I'm definitely having a technical error.
That's fine. Just while Amy's doing that, you're going to pull it back, or do you want me to ask you a couple of questions, Amy?
Yeah, I'm going to pull it back, but if not, I've got a slide where I can actually just pull it up and I can show you what they can see. Let me try this one more time. I'm so sorry, everyone.
That's fine. Well, whilst we've got a minute, we're going to be doing our Q&A in a second, so now's a good time. We've had some questions coming through, so feel free to drop some more in just while Amy's putting this back up.
Okay. Cool. I've got this up now. Okay, cool. Yeah. So as you can see, I'm in the client view. I can always go back to my advisor view, but this is where you get the deeper credit insight here. So you can see your client's credit score, their credit history over 12 months. By the way, this score is really important because this is the score that the lenders and the people who are giving supplies will see. These are the ones who are typically reporting into Experian as well. Clients' bank balances and their lending facilities, but you can also give them insights on how they compare to other clients in their industries and actions they can take, right? So if the supplier, if their credit score has gone up, can they go negotiate better supplier terms, etc., and how other companies pay? Obviously, we've got those credit risk factors that I just went through, public records, their payment performance, payment industry and their average. But this is really exciting here. This is called the Keys and Cato data. So your largest banks, think your Lloyds, your HSBC, whoever that is required to report bank balances into Experian by the Competition Markets Authority. So what we can do is we can actually surface this data from Experian that they hold on your clients. So you can see historical cash trends, credit card balances, credit accounts, so telecoms. One thing we find is coming up a lot right now is people looking to switch energy bills. So they can find out information on that. And ultimately, when clients are getting knocked back, they can look at this too and think, okay, well, I don't think that's right. And this can also spark that credit review service. And then, as I was talking about before, in here, with just the company number, clients can track the credit scores between 10 to 100 different companies every single month, year, whatever that is that they want to do. And they can also just pop the company in, download a credit report on them. But as I was talking about in that business cash flow cycle earlier, perhaps they're really excited that they've got a deal coming in with Tesco, but they could figure out that Tesco pay on average almost 200 days late. So they could manage their cash flow better and then be notified of any changes. This is really, really important when we're talking about the budget and thriving and the fact that we are still going to contract by 0.2% this year. We never know. Those are just forecasts, but it could be worse. It could be better depending on global things. But the one thing you can do is help your clients manage their risk early on. And again, clients are able to come in here, start funding searches. You can also do this on their behalf from your advisor portal, but this means they can go in, look for it when they need it. Maybe even when you don't have a meeting coming up, you'll get notified to be brought into that process. And then, depending on the advice you want to give them and how much you want to put in, but this can save you time from collating a lot of information when the client could actually do that themselves and still enable them to get the advice. And then they can track all of their applications in one one spot. On here as well, I know we don't have the button, but this is actually where that ability to do the credit review service will come in as well. So they can launch it from here, come straight into us. It's a super easy process, and we can do it within a matter of days. That's how quickly it goes through. So it's not a long, strenuous process. Anyways, thought I would just show you that. I'm going to try clicking back here, see if that works. Yes. So you can do that for every single different client. And again, that entire screen is just populated from all the Experian data. So not even from cloud, which is quite good for those clients who might be a little bit naughty when it comes to their bookkeeping. So anyways, I'm hoping, that you've taken a few things away from today. As I said before, you can sign up using that link. We'll send it out after. You can pop in 10 clients. You can understand what's going on within your own client portfolio and start to get a feel for if there's anything emerging. But yes, I am ready for questions now.
Amy, and I'm just conscious of time, so we'll do a couple of quick questions just to take us up to the hour. So we've got one from Mark. Thanks, Mark. Do you see less choice being available for loans for SMEs in the coming sort of 12 to 18 months with issues in the banking sector, higher interest rates, etc.?
Well, I think I touched on that a little bit. I think it'll depend what happens in the banking sector, but what I have tended to see in my time working with SME lending, which is years, and especially the years where we went from having 40 to 350 lenders, is that people will try to come into the market to fill that void generally, but what they might come in with is higher interest rates, personal guarantees, and ultimately I think a lot of what we see is a business coming in being like, I want a loan for 5 years and I want to pay down a monthly fee. But the truth of the matter is there's great lending products out there like asset finance, invoice finance, property finance, bridging loans, whatever that might be. And if we can get that small business to change their mentality a little bit about, okay, maybe it's not just a loan, maybe we want to look at leveraging some things on your balance sheet, we can open up better rates too. So I think it's just about how we manage the process, but there could be changes in liquidity depending on what happens in the banking industry.
And client permission. So do you need permission to run a credit check on a company, or if you're adding clients into this platform to sort of check their health score?
No, absolutely not. Right. This is all publicly available data. Anybody could go buy a subscription to Experian Credit Save. You can look at any company on Companies House. The only thing that our platform is doing is taking that Experian data and that Companies House data and surfacing it for you in a way that accountants can manage a portfolio, right? So absolutely not publicly available data. It's just the way that it is managed. And then for those client Experian profiles, right, you invite your client. The director actually needs to verify. They'll get an invite from their accountant. They verify, they give their personal details, they confirm that who they are, they go through a GDPR check before we can actually populate any of that information for you to be able to see it, and the client as well. So there's a conversation that happens there. Yeah,
that's perfect. Thank you so much. And that's us for time today. So thank you so much for that, Amy. That was fantastic. And just to confirm with everyone as well, we will be doing a follow-up email. You'll get a copy of the recording as well, and the copy of the links and stuff that we've shared. All of that will come out into an email as well. And feel free to share a copy of the webinar with any of your colleagues, anybody else you think will find it relevant as well. So thanks for joining us today, and thanks so much for that, Amy.
Thanks, everyone.
See you. Bye. Bye.
Bye.